Welcome, everyone. Welcome to tonight's virtual event for IntentGen Financial Partners. As I was thinking about our night tonight, I think about the way Zach does talks oftentimes where he has a theme. And tonight, my theme is the 3 C's. And the 3 C's for 2020. And the first C starts out with challenge. 2020 has been a challenge, to say the least. I mean, obviously, people have been sick. And people have been worried about being sick. People are forced to alter and cancel their plans. And not only those items, but people are oftentimes looking for things that normally we take for granted. And earlier this year, we know toilet paper was really hard to come by. And so that was one of the challenges that everyone was facing back in earlier this year. But as we work through it, things changed. And that's our second C. Lives are changed forever. The world is now a smaller place. We're having Zoom calls with friends we haven't talked to in years, and we're more efficient because of programs like Zoom. How we live our life is different. We have new activities, things that we didn't do before, that all of a sudden, because we're forced to, people are doing those activities. Things like walking around their neighborhoods, things that people never used to do, having dinner at their dining room table just because of the sheer volume of time that we had together. Social gatherings and events have also changed, and not only those items, but we've all lived through the education system changing and how we're educating our kids while staying safe. But the third C, that leads into the third C, and that is continuity. Life goes on. We found new ways to connect. We've rekindled new passions. Things like, for me, for instance, I started cooking again, which I hadn't done in years just because life's been so busy. But when we pause, we can do those things that we used to really enjoy, but for some reason we got away from. And I'm pretty sure wine consumption is up, which I don't, you can look at that as a pro or a con for 2020. At IntentGen, we've also dealt with all 3 of these C's. Recently, the challenge of repapering and transitioning 3,000 accounts out to you, our clients. First of all, we know that was a burden for you, and we just thank you for your patience as we went through this. The change to Thrivent Advisor Network, again, you have to have new logins, new statements, and we just can't tell you enough how much we appreciate it. But that leads to continuity, the continuity of our mission. And the reason we did these things is because we'll have access to greater solutions. We'll have greater partnerships with accounting firms so that we can offer greater services to you so that we are able to continue our mission. And our mission is to help empower people through greater planning and services to live life with a greater purpose. Thank you for joining us tonight.
And as Corey said, greater purpose. We know that greater purpose can mean a lot of different things to different people. It can mean more fun, more travel, although perhaps not in a year like this, different work, less work, more work. And it can also mean giving and serving. And one of the places that I serve is at Augustana College. And in my work on the board of trustees there, I experienced something that many of you have likely experienced as you serve and give, and that's that we often get more than we give. And one of the things that I've received from my service at Augustana is the chance to connect with new organizations and companies. And so the firm that we work with on a lot of our research, DeMayo Schneider, is a firm who helps Augustana College with their endowment. Another thing that I've received from my work there is new relationships, the chance to meet people that are a lot smarter than me, that have done really cool things with their lives and who still live with an attitude of service and gratitude. And one of those great people is our featured speaker tonight. His name is Michael Gapin, and Mike has become not only someone that I've grown to respect and really admire in terms of his professional life, but he's become a friend too, someone that I know seeks balance in how they live out their life with family, with purpose, and in their professional life. So Mike and I have a lot of commonalities, which I'll speak of in a minute, but the difference is the intellect. Mike is what you might refer to as the smartest guy in the room, and that's part of why I wanted him here with us tonight. His bio you should have received, but his bio is fantastic, a PhD in economics from Indiana. He's worked for the Federal Reserve, for the International Monetary Fund, and he's now the chief economist at Barclays Bank in New York City. But there's a lot more to him. Mike and his wife live outside of New York City and have 4 kids. Does that sound a little familiar with me? So he knows the chaos of a busy life and he balances that with his work. He also has a little bit of a sports history. He's actually from Naperville. As I understand it, some of you on the call tonight went to high school with Mike at Naperville North. And he was a basketball player there, went on to Augustana College and played hoops there as well. So Mike, a well-rounded individual, incredibly smart, and we keep getting some similar questions from our clients, questions about the economy and the markets in the upcoming election. And we thought, who better than someone who forecasts the economy at the highest level for places in our country. So Mike, with much gratitude, I want to say thanks for spending the evening with us. We've got clients and people here from all over the country tonight, over 100 people logged in, and I know we can't interact with them, but we appreciate you being here to enlighten us. And for our people listening in, if you've got questions, you should see this on the screen, but please go ahead and email me, Zach@IntentGen.com, and Mike's going to spend some time in Q&A with us when he's done with his formal presentation. So Mike, I'll turn it over to you, and thank you.
Thank you, Zach, for that kind introduction, and thank you, Corey, and everybody for inviting me onto this call. It's a pleasure to be here and share some of our thoughts about the outlook for the U.S. and the global economy and what that might mean for the outlook on asset markets. I mean, obviously, there's more than we can cover in about 15 to 20 minutes here, so I'll try and keep my thoughts at a fairly high level and tie together some of the themes that we see emerging from the economic landscape and how that might translate to the asset market view. I'll discuss a little bit of the near-term outlook, how we see the challenges for the U.S. and the global economy through the end of the year, and then we'll also have some comments about how the election might affect the outlook for the U.S. economy going forward, and share some of our views on the medium term. As I walk through this, I will put up a presentation that we shared. I will not go through every slide. There's a lot of information in that chart deck. I'm just going to pick out a few points here. So please let me share the screen with you as my remarks go forward. Once a quarter, we at Barclays get together and we try to provide a coordinated view. We get all of our economists and strategists and asset allocation people in the room, and we try and hammer out a consensus view. What is the macroeconomy telling us? What are individual asset markets telling us? And then therefore, how do we think about asset markets in a global integrated framework? Now, this is the economic side of that input, and our most recent global economic outlook, which was just published about 2.5 weeks ago, really came with the theme that the global outlook was better than feared. We kind of had a 1-2 punch. I'm looking here at the table on the left. This shows PMIs, or the production indices in the manufacturing sector, as well in the US as well as globally. Early in the year, of course, China took the hit to activity first, and most of the US and European economies and Japan took the hit to output in the second quarter, as we had stay-at-home orders in place and economic lockdowns in place to try and slow the spread of the coronavirus. And you can see in the chart on the right here, global trade volumes plummeted and then rebounded quite quickly. So how is the economy today compared to pre-COVID? Well, I would say what the main feature that we're seeing is that households in the US and globally shifted their consumption basket very quickly in the direction of goods consumption. We weren't going out to restaurants, we weren't getting on airplanes and going to hotels, and we were essentially switching our consumption to goods, and durables in particular, autos, home furnishings, where we were building out home offices. We were calling this feature of the economy the great nesting. If we were going to be home for the next 6 to 9 months or longer, well, there were things we needed to improve around the house. If we weren't going to take public transportation, we should maybe think about upgrading the vehicle or adding a second vehicle. So we often kind of refer to the recovery in terms of alphabetical letters. So if there was a V-shaped component to this recovery, it was mainly due to a rebound in goods production. So yes, activity retrenched in the second quarter, but rebounded very quickly as we came out of the second quarter and into the third quarter, and households shifted their consumption preferences in the direction of goods. Now, in the U.S., for example, at present, households are buying more goods now than they did in February. So spending on goods is above pre-pandemic levels, just to give you an idea of how much of consumer consumption bundles have changed. This is true in what we're seeing in the European data, as well as some data out of the UK. Now that has helped economies recover quickly, and is part of why we have a less dire growth outlook than we had feared previously. We're thinking on average it's going to take about 8 to 10 quarters for some of the major non-China economies to get GDP back to where things were at the end of Q4 19. In the US and Germany and across the EU, on average, we're looking at about 2 to 2.5 year turnaround time. That's actually about 3 to 4 quarters sooner than we had thought just several months ago. We're a little less confident about what all this means for the emerging market economies, but in general, we've upgraded our growth outlook for the developed market. So the rebound in the good side of the economy has been quite strong. That has snapped back activity in many economies. It's actually boosted trade volumes again. So we're sitting here now going into the fourth quarter with activity having rebounded quicker than we thought just several months ago. Now, looking forward, however, we think that there's reason to suspect that economic momentum, both in the US and abroad, is slowing and will slow. And the main reason for that is, just as I was mentioning, that the initial rebound came in goods. Obviously, there's still a lot of lost ground to be made up in the services sector. It's always harder to make up lost output in services than it is to make up lost output in the goods sector. So with spending on goods already well above pre-pandemic levels, it's going to be harder for manufacturing and goods consumption to lead the way. And if we're going to make up more ground and recover lost output that we've had from the pandemic, it's going to have to come from services. So we've gotten that sharp rebound out of the goods sector. Services activity is where spending is still well short of pre-pandemic levels. So further recovery is going to have to come out of the services sector. And that's why we're still saying, hey, things are better than we thought just a couple months ago. But looking further out, it's still going to be a long recovery. And that's mainly because the coronavirus, as we know, is still circulating. We'll get to some of those details in just a moment. But we've become a little more optimistic, but don't forget just how far we have to go. So there's an initial rebound where we look here on the left, global GDP is maybe down about 11 trillion relative to where a pre-COVID baseline would have suggested. About half of that is coming out of advanced economies. So the initial snapback has been pretty healthy, but we still have quite a long way to go. And that's mainly because growth is transitioning from goods and over into services, where making up that lost ground is a lot harder. Now, I think one of the positive aspects also about why we're more confident in the global recovery relative to a few months ago, and even relative to the way that the world looked coming out of 2008, 2009, is that monetary and fiscal policy are very much on the same page. Coming out of 08, 09, the story in many places was austerity. Europe was pursuing austerity. Nobody was talking about fiscal support. In the US, the TARP Recovery Act was only about 700 to 800 billion. This time around, phases 1 through 3.5 of fiscal spending has been several $1 trillion. Nobody's talking austerity. The estimated fiscal deficits have certainly jumped dramatically. What that has done is limited the loss of wage and salary income on household balance sheets and helped hold parts of economies in suspended states of animation during lockdown, and has enabled a quicker rebound in activity. And obviously central banks moved very quickly to quiet market turbulence and to provide guidance about how long rates may stay low, and jumped in to buy assets to support confidence in market functioning. So in the last recovery, fiscal and monetary policy were working at cross purposes. They were not supporting each other. This time around, both monetary and fiscal policy appear to be on the same page. So we're not using lockdowns anymore in general. The next phase of the policy response is coming from supportive monetary and fiscal policies, and hopefully an outlook that will become one where we can gradually get control of the coronavirus. And I say that because obviously I know cases are rising. They're rising again in the Midwest and in parts of the West. They're rising again in Europe. But we've become incrementally more, I hate to use the word comfortable, but we've become a little more comfortable with the ability of economies to grow even with large numbers of COVID cases circulating. Now, that's because of progress in both medical treatments and our view about a timeline for a vaccine. If we had had this conversation 3 to 4 months ago, we would have been saying things like, wow, a vaccine in 2021 seems like a very high hurdle. Now, all of our internal consultants, our external consultants, some of our biotech analysts, all of them are saying there's a very good chance we'll have at least one vaccine approved by the end of the year, and large numbers, potentially up to millions or close to 100 million people in the US and Europe vaccinated maybe by the end, excuse me, by the end of the third quarter of next year. And again, that would be record pace. It is not what we were thinking several months ago. But we could very well be looking at an outlook where we have a vaccine that comes sooner than later, again, relative to what we were thinking several months ago. So I think it reduces the odds that states need to lock down economies again. And I think it increases the chances that we can recover lost ground over the medium term and limit what we call economic scarring, long-term unemployment, much weaker potential growth. So recessions like this tend to have very long-term negative effects on economic activity and potential growth, attachment to the labor market, and anything that can turn that around and limit those losses will enable economies to recover quicker. Here's just, I'm not going to run through all these numbers, but here's kind of how we would see growth rates. You can see that I'm looking at the second set of columns there, the 2020 numbers at minus 3.7%. That would be a calendar year average decline in growth globally in 2020 versus 2019. Our number there is minus 4.5 for the US. Actually, since this has been published, we actually upgraded our US forecast. That number is now minus 3.5. But look at the growth rates that we have for 2021 and 2022. That's a pretty sharp snapback. And if you go further down into the advanced and emerging economies, again, large declines this year, but pretty solid rebounds in 2021 and 2022. Again, that's keyed by what we think will be progress on the medical front, as well as the combination of supportive monetary and fiscal policies. If you wanted to scroll further into this, we have a bunch of information here on the US as well as the Euro area. What I'm going to do is leave that for you to look through, or if you have any questions, please feed those through to Zach, or you could follow up with me at a later date. What I'd like to do is just come back on camera, if I could, and share to you again that the thoughts on the near-term economy versus how we see the U.S. over the medium term. Now, I will paint what I think is a fairly constructive view on the U.S., and I'll tell you what we think it means for asset markets. But I think if we have concerns, the concern is actually in the near term, say between now and the end of the first quarter of next year. And I think there's 4 reasons that we have concerns at the moment about the near-term trajectory for the U.S. and in turn the global economy. One is what I mentioned, that transition from a good sector rebound to needing to recover activity and services, and that is always harder. The incoming data is pointing to deceleration. We're seeing this in retail sales data. We're seeing it in industrial production data. We're seeing it across a number of very high frequency indicators that suggest the pace of recovery is slowing. Household demand for goods is feeling satiated, and now we're moving into those harder to make up activity sectors. So that would be one, what I'd call the transition from goods back to services. And one of the reasons that is so hard is the rising number of COVID cases. We're back to roughly 50,000 or more cases a day. At present, hospital systems don't appear to be under tremendous pressure, and the death rate is still relatively low. I think advancements in medical treatments mean we probably need to push that number to say 100,000 cases a day before we start risking states that are say seriously considering locking down their economies again. But anytime COVID cases are circulating in large numbers, it of course means we're going to be reluctant to get out and do activities related to services. So those two things together are part of the problem. There's also this issue around phase 4 stimulus that negotiations are ongoing. We took it out of our baseline several weeks ago because negotiations were not proceeding well in our mind. And so we've actually taken near-term fiscal stimulus out of the baseline. We pushed it into a post-election environment. But obviously, the CARES Act transfer payments expired at the end of July. Personal income is now coming down quite sharply. So we're not making up lost wage and salary income as we did previously. That's likely to mean less momentum in personal spending going forward. So there's no immediate fiscal bridge to help carry the economy to a point where we may have that vaccine next year. So that's a near-term risk, a sharper drop-off in spending and a potential uptick in unemployment. Finally, there's uncertainty about the election. Are we going to know who the winner is, in what order, in what time? Are there going to be court challenges? There is a risk of several weeks or more of protracted uncertainty that could mean people are reluctant to spend, businesses reluctant to hire. So those four things together lead us to be less comfortable about the near term. But as we get further into 2020, as we get past the election, our view is we are going to know who the winner is. There will be a winner. There will be an administration and a president inaugurated in January. And both of these administrations, in our view, will likely put forward supportive fiscal policies. A Trump agenda is likely to be more skewed to tax cuts for corporates or middle-income households and general increases in budgetary expenditures. A Joe Biden win that brings along the Senate in a so-called blue wave is likely to have an infrastructure-heavy package, a multi-year, perhaps multi-trillion-dollar spending package geared to infrastructure, education, and health. That could be very helpful in underpinning the growth outlook in the U.S. for several years. It's also likely to come with revenue raisers, a higher corporate tax rate, a higher marginal tax rate on upper income individuals. But on net, we think both administrations are likely to pursue fiscal policy that is supportive of economic recovery. As I mentioned, we do think a vaccine will be available at some point in 2021. That's at least partially effective. And then finally, monetary policy, we think will be accommodative for as far as the eye can see. The Fed is telling you they will not choke off a recovery on the expectation that inflation will rise. So we think a minus 3.5% economy this year could be followed by a 4% growth rate next year, a 2.5% growth rate after that. So it's a fairly constructive view. There's obviously a lot of uncertainty and risks around that, but things don't appear to be as bad as we thought in the March, April, May time period. And we think that there's some room for optimism. And what I'd like to do just with my last few minutes here is, before we go to questions, is just give you a primer on what we think this means for asset markets at a very high level, broad brush setting. Now, we think that this is a pretty favorable environment for risk and equities in that regard. If we think the economy is going to recover with fairly modest rates of inflation and supportive fiscal and monetary policies, if we think the economy is going to recover, that's likely to be beneficial for earnings, profitability, and equities. Obviously, where equities are valued at present, you have to wonder, well, where would we want to do that? I think it's a reasonable question to say maybe valuations in tech might be elevated. Should we consider Europe versus the US? Should we consider non-work from home stocks that don't seem to be quite as expensive as some of the technology stocks do? And so I think there is room for thinking about select cyclicals and select industrials and ways to position in equity markets. But I think our view would certainly be we prefer equities over global fixed income. With central banks buying tremendous amounts of assets, pledging to keep interest rates low, inflation adjusted returns and global government bonds are likely to be low, if not negative, after you account for inflation for quite some time. So on a risk adjusted basis, we would still be biased towards equity markets. We do think yields in the US will be gradually moving higher at the long end. Expansionary fiscal policy, perhaps less trade policy uncertainty in a Biden administration, or in a Trump administration, lower corporate taxes and regulatory relief. All of these things argue for higher, longer term interest rates in the US, but we think that will be a gradual process over time. So large fiscal deficits, increased fiscal spending, likely to push up longer term yields. And then finally, I think that the view on the dollar is one that it depends on what administration comes through. The argument would be that less trade tension and higher corporate tax rates may be dollar negative in a Biden administration, perhaps trade frictions as well as lower corporate tax rates in a Trump administration may argue for some dollar firmness or dollar strength. So we'll have to see on that front, but we think it's a fairly positive backdrop for risk assets relative to global government bonds. And that would be our take on things right now. Certainly betting on the ability of economies to recover over the medium term, but we obviously see some pitfalls between now and say Q1 of next year when the new administration is in place. So Zach, why don't I stop there and turn it back to you in the audience for questions and comments.
All right, Mike, thank you very much. That is fantastic. I loved your perspectives. It's fun to hear insight and commentary that's factual rather than just a bunch of opinions from either side. So I appreciate your ability to do that well. We had a couple questions come in. So I brought Jacob, our Director of Financial Planning and Investments, on with us. Jacob also is an advisor for clients as part of our team. And Jeff and Jay, who are advisors of ours, are not on screen with us tonight, but they're here. We know many of their clients are on with us as well. So if other questions are out there, please email them to me. Again, it's zach@intentgen.com. That's INTENTGEN. So a couple questions, Mike. I've got one for you in a minute. You can think about the question that came in was, what happens with all the debt that's out there? It's like it's kind of fake, $26 trillion. And then are there any levers left to pull on monetary or fiscal policy to help if we need? Before we get to that, Jacob, another question came in. Mike talked about concerns in the near term, some optimism certainly in the long run, but what do people do then if it gets volatile in the near term?
Yeah, great question. Probably one that we field from, anywhere from 3 to 4 to 5 clients per week that we've got this upcoming election. I think Mike hit on a number of the points of potential concerns, but really validated that there is actually some stronger outlook regardless of what political party becomes in place. And so I think if we take a step back and really look at what the economy and the markets have done over this last year, if we look back to the conversations we were having in March in the springtime, we saw significant headwinds and really a depletion of assets based off of the markets, and then led to a recovery. And so this point heading into the final part of the year has really allowed us to press pause and reassess and revisit what are your objectives of your plan? I think that's the biggest thing that you can do in the near term right now is revisit what are your objectives. So looking at assets or your plan from an income perspective, money coming in or money coming out, looking at taxes, looking at near term in the next year, what your needs are from your asset base, as well as in the next 3 to 5 years. And that will really allow you to revisit to say, what risk do I actually need to take in my accounts right now? And is my plan set up well to be able to fund my needs and my objectives in the upcoming year? And so I think revisiting probability, and so looking at what's the appropriate equity to fixed income mix based off your objectives. I think what we found in some conversations with clients is they may actually be a little bit more aggressive than they need to have planned probability of success. And so revisiting that's really important. And then just in the short frequency of a final quarter, I think there's important tax things to look at. And so there is some potential tax impact based off of a political party. I know that's a little bit of speculation at this point, but this is something that we always talk through with our clients as we head into the fourth quarter, is looking at what gifting do you want to do, looking at potential capital gain impacts. So we're starting to get capital gain estimates from our mutual fund families. And then capital gains tax brackets that could potentially change. And so we may want to accelerate some gifting into this tax year rather than deferring, as well as looking at federal marginal tax brackets. Are there opportunities within your tax bracket under current rates and legislation to potentially take money out? So I think those are important things to be having conversations to look at in the immediate near term final to 2021.
That's great. Thank you. And Mike, just another question came in to kind of piggyback on what I said with a little more specificity. So what about all this debt that's out there? What does that mean? Are there more options for stimulus? And then as you get into that, maybe I'll follow up with just kind of a couple very specific things that were asked.
Sure. I'll do the second question first. Any levers left to pull on monetary and fiscal? I mean, monetary, not really. I mean, I think the main thing the Fed could do if things soften would be to buy more assets. They're buying 120 billion a month right now, so that number could go up. They could shift their purchases into longer duration instruments, but they really don't want to go to negative rates. Yield curve control is not really on the agenda. I mean, monetary policy is kind of at its limits. We know monetary policy is constrained in a zero lower bound environment, and that's essentially where we are. The Fed's got the fire hose on at the moment. There's not a lot more that they can do. I mean, fiscal, can they do more? Well, sure, they can do more. And I do generally agree with Fed Chair Powell when he says the risk of doing more right now doesn't seem to be all that bad relative to the risk of doing nothing. And part of that is just because the way things are globally right now, there's just a lot of disinflationary pressure. Yields are quite low. So the idea that there's going to be, say, a debt-fueled rise in long-term real rates that slows down activity, that I think that seems to be a pretty low risk. So I mean, my argument would be it's not that fiscal needs to do more. I think we generally know what we need to do, which would be some combination of what I'll call more disaster relief, plus let's call it a medium-term spending plan that does some things to address infrastructure, education, and health. And the reason I say that is I do think it would be helpful for what I'll call direct government spending into the economy, right? So last recovery, we did more about cutting taxes and hoped that firms would use those extra resources to hire more and invest more. It's likely a lot of that went into things like share buybacks, not criticizing, just saying that you're relying on indirect activity. You can cut taxes, but maybe households will spend, maybe they won't, maybe businesses will hire, maybe they won't. It's the whole, you can lead the horse to water argument. Increased government spending may anchor the growth outlook more clearly, and therefore you might get a more catalytic response by business investment. But in general, I don't think that there's more monetary can do. And fiscal, I would say, you know, we're likely to get something, but the composition of that will depend on the administration. So what are we going to do with all that debt? I think the answer is, well, some of it will just carry. Some of it we'll have to pay off with taxes. After episodes like this, if you look at all the cases historically and go back in time, tax rates generally go up at some point. So part of it we'll have to pay probably with higher taxes. And third, some of it will be monetized. I'm not arguing here that the Fed is pursuing MMT, but the Fed will clearly be buying assets for quite some time, in our view, probably through the end of 2022. So some of this will indeed be monetized. So I think it'll be one of those three. We'll carry some permanently, we'll pay some off with taxes, and the Fed will be monetizing some. In the next few years, it's unlikely that is going to lead to a lot of inflation. Further down the road, we'll have to see. But I think the last recovery told us that the risk of generating a whole lot of inflation seems pretty low, and I think the Fed's banking on that at this point in time. What was you had a third follow-up after that?
You actually touched on some of the specifics that came through. So there were questions on the fiscal policy and then the MMT that you spoke about. So I think you answered that really well. I've got a couple others that are coming in for you that we'll get to in a second. One of them has to do around the housing market. What do you predict may happen if there's extended unemployment or underemployment, kind of in the service sector, so to speak? Also, a question about social unrest and how does that affect the economy going forward? Before we get to those, Corey, I'll throw this one to you. There was a question that came in around the comments about the potential for rising taxes. So what does a person do about that possibility?
Well, actually, I was really hoping earlier that Michael would tell us who's going to win the election in November, and then we'd have a clear pathway on how to handle those things. But in reality, we'll have to wait and see what happens in the election. Biden has already come out and said that he sees a pathway to raise future taxation. And so I think what we've been doing with clients is really looking at what is their marginal tax bracket today? Where are you at now as far as your current income? And when we look at that to say, should we be taking more out of IRAs at this stage of the game? Should we be converting money from IRA to Roth IRA now to take advantage of these lower tax rates? Because as Michael shared, some of the debt has got to be paid for by taxes at some point. We don't know if it's next year or future years, but it is coming at some point. And so to utilize taxes today to transition some of those dollars that we may not need until further on down the future, or we may never need, makes some sense. And when you think about it, the tax brackets used to go 15 to 25% tax rates. They used to go 15 to 25. Now they go 15 to 22 to 24. So there's actually two brackets you can go through from the 12% bracket all the way to the 24% bracket before you even get to the old second bracket. And so what we work with clients is to look at marginal tax brackets and say, how much do we want to recognize now so that we can prevent greater taxation down the road?
That's great. And you bring up an excellent point, whether we're in a quote higher tax environment or lower. If you look back historically, there's always been marginal brackets. And so it's important that people forecast forward to what their marginal will be, not just what the overall rates may be. So Michael, I'll throw it back to you. If you would please address those questions on housing market and social unrest.
Yeah, on the housing market, I think the pandemic, I think, is supporting the owner-occupied market at present. There's certainly, I think, been a increase in housing demand, particularly in, say, suburbs and exurbs of the larger metro areas. So a move out of rentership positions in the city to owner-occupied housing in the suburbs, that seems to be fairly clear. The overall housing market, in our view, is in pretty good shape going into the pandemic. There were not high levels of inventories. Home builders did not overbuild, so there was no kind of boom bust to correct. We stopped building for a couple months, and then we turned the spigot back on. And so I think in the near term, it's supporting the owner-occupied market. And we know that there's a lot of forbearance in the CARES Act. If you fall delinquent on your mortgage, you can apply for forbearance, and you can get that for up to a year. So we're likely not to see a spike in foreclosures follow the rise in delinquencies until around the middle of next year. So there could be time to work some of these loans out. We don't expect to see the fallout in the housing market like we saw after 08-09. So probably home price appreciation here in the near term, but that should slow in 2021 as around the middle of the year, when we think forbearances will rise as a result of the expiration of that forbearance in the CARES Act. So delinquencies today, but foreclosures tomorrow, and that'll weigh a little bit on home price appreciation. At present, if there's a negative in the housing market, it's definitely the rental market. Rents are slowing. Demand for rental properties is down. Rental inflation is slowing. It's one of the reasons why we actually think in the near term, the risk is to less inflation, not more, because rents and owner's equivalent rent are a very high component of core inflation. So it's bifurcating the housing market a bit at present. Extended unemployment. Look, this is still a huge concern. I painted a fairly optimistic picture about the economy, but there's some numbers here worth noting. We're still short on employment by about 11 million relative to when we went into the pandemic. We lost about 22 million jobs. We've got about 11 million of them back. The surveys break down that unemployment into temporary and non-temporary. About 4 million, a little over 4 million of the 11 million are classified as non-temporary layoffs, or closer to permanent unemployment. That number has come up several million, of course. So in the last 2 months, it's come up about 1.5 to 2 million. That does suggest that there's what we call scarring in labor markets. Obviously, the best case scenario is if you were laid off, it would be temporary and you could get hired back quickly. So the level of unemployment is coming down, but the share of that unemployment that's being classified as permanent is rising. And that's indicative of kind of longer term negative ramifications on potential growth. Now, is 4 million bad? How does that compare with history? Coming out of 08-09, that number was about 8.5 million. So at present, about half as much scarring as we had in labor markets relative to the last boom bust downturn. I'm hopeful that a vaccine, medical progress, supportive monetary and fiscal policies will limit the amount of longer term scarring in labor markets, but it's something that we're watching very closely. And then finally, social unrest. Obviously want to be careful about comments I make on this, because I don't mean to diminish the impact of it. When I look historically, I think it's my job to tie macro events or political events to market outcomes and financial market outcomes. I'm not entirely convinced that social unrest could do that. And here I'm kind of thinking historically into some periods in the 60s and early 70s where there was a lot of social unrest, but for different reasons. I'm not convinced it had, say, a material effect on the economic outlook, and I'm not convinced it had a material effect on asset markets. So from a political economy point of view, and from the point of view of developing, say, unity rather than antagonism, we definitely want to come together after this election. We don't want to see social strife and social unrest, but I just have a hard time saying if we get it, it means asset markets aren't going to perform well or the economy isn't going to perform well. History tells me that it's a social problem, not necessarily a macroeconomic problem. Certainly something we need to address as a society, but I think I'm less equipped to speak about it and its effect on asset markets from a professional position.
That's great. I think that's a very fair assessment of it, and obviously a tough topic to try to predict or project on. So thank you for the comments for that. We had kind of said to Mike that we'd have you on for about a half hour, and we keep getting questions coming in. So I appreciate everyone who is emailing in those questions. I'm going to cap it now, but I want to offer two things. One is we're here to talk through this. We can be an extension of Mike. If there's something that's way beyond our pay grade, we'll certainly get it to him afterwards and circle back with you directly. He's been very gracious to offer that to us. But I'll leave it with kind of these last two things. So one question came in, this is very broad, but looking at how we were in a lot of ways approaching kind of what people thought was the end of a bull market through last year and the beginning of this year, maybe some slowing economies. And then we had this shock to the system. Are there things that are going to lead us strongly like into the next bull market? So the person threw out technology. Is that a sector that there's enough of a technology revolution that can continue to run the bull market for a long time? Obviously speculation, but we'd love your comment on that. And then also, since I threw technology as a sector, are there things that you see as sectors that are very divergent based on the upcoming election? You mentioned already education, infrastructure, and healthcare, but if it's Trump, you want to comment a little bit on that administration, what may be helpful, or kind of reinforce what you said earlier?
Yeah, I think the way that our equity strategists would respond to this is, I think the first thing they would say is the pandemic has pushed kind of normal definitions aside. So it's harder to talk about cyclicals versus value versus growth versus defensive. Some stocks that have defensive characteristics today in the pandemic would not be normal defensive stocks in a recession, in a normal recession. So I think we do believe that there are some permanent winners that are coming out of the pandemic, and technology, broadly speaking, would be one of those sectors. So are there large firms that are positioned well to increase revenues and gain market share and hold that market share permanently coming out of the pandemic? Are there technology firms that have expanded and opened new markets in ways that they didn't have them before? So the obvious ones, the Netflix of the world, the Amazons of the world, the FANGs, I think there's a reason they're getting bid the way that they are, and they're viewed as winners and able to gain market share coming out of this. So if the pandemic has been a problem for business, it's been more in the area of small business and very small business. And it's the larger players are viewed as financially more nimble. They have better resources, and I think the technology sector is viewed as kind of a more permanent winner. Now, I think that there's a second level of stocks or companies that I would call, say, temporary winners coming out of this. And I wouldn't say that our preferences would be geared so much to Trump versus Biden as to whether or not we get a vaccine, if we're right on the assumption that a vaccine comes in play. So like, for example, right now, as I was mentioning, we had a strong shift in consumer behavior and a shift to goods purchases. Right now, people want to buy homes in the suburbs, for example. The trade deficit is almost as wide as it's ever been in recorded history, because when we buy goods, those have high import content. But if we get a vaccine and there's at least some normalization in behavior, you can imagine some of this reversing next year. So are there select cyclical stocks and select industrial stocks that would benefit from that kind of normalization, or at least, again, I'm not saying that the world just goes back to we do everything that we did the same way that we did before, but you can imagine some of the distortions getting unwound. So certain, what I'll call select industrials and select cyclicals would make sense, but we would avoid things like energy and bank stocks, for example. Sorry to say that to the employer here. But when the deposit rate's going to be as low for as long as we think it's going to be, and long-term rates are going to be as low, it's hard for banks to monetize that kind of yield curve. So what I would say, what I would target more is the work from home basket has really done well. Technology and Home Depot, home furnishings, that's done really well. It may not do quite as well next year if we're right on the vaccine and you get at least kind of some gradual shift back to normal spending behavior. So that's the way that I would treat it, is selected cyclicals, selected industrials, and look in the non-work from home basket if you're looking to, say, add incremental equity exposure to what you already had. Zach, so I hope that addresses your question.
Mike, that was really, really helpful. And I know that's a question that's out there from a lot of people. So thanks for covering that. I said it would be the last one, but one more real quick, and this kind of ends on a global note. There's been trade tensions with China. We had this very global economy. It's because of COVID, a lot of things have shrank. What do you see in the future around trade and that environment? And then as we start to open up international versus US in terms of value?
Yeah, I think one of the, when you're a US economist, you tend to be domestically focused just because that's how the US is. But the global market and global trade flows have been an important source of risk in prior years. I think in a Biden administration, I would expect multilateral trade tensions to go down. I would expect a Biden administration to want to reinvigorate longstanding post-World War II ties through things like NATO and whatever could replace the Trans-Pacific Partnership. So I think he would try and reinvigorate the old alliances, and for what purpose is the question. And I think the purpose would be to push back against a resurgent Russia and a resurgent China. So I think we would still have an antagonistic view towards China. I don't think we would be using tariffs to do it. I think it would come in areas like the blacklisting of technology companies. I think it would come in the prohibition of Chinese companies investing in the US. This would be the Committee on Foreign Investment in the US, so-called CFIUS in the Senate. So I think it would be more about, you've probably heard the terms decoupling and kind of pulling apart the technology side of the two economies. Full decoupling is not going to happen. But my point here is I think he would try and reorient these post-World War II institutions as a check to rising China power and try and ring fence important national security technology. In a second Trump administration, I think you would see kind of going back to those same trade tensions. And I think we would be using tariffs as a cudgel against any country that had a large trade deficit with us. At the moment, that would be going back to China. The trade deal we had with China, obviously the pandemic meant we weren't going to kind of hit the targets. So I think in Trump 2, I think would look similar to Trump 1. I think we know that playbook, the old order would be gone. Not only would we be kind of threatening retaliatory actions on China, we'd probably be going after autos with Europe, for example. So I think there is kind of a market shift in the policy platforms is when you get to trade. That would be at least my interpretation on the global fronts. It's why, for example, the dollar could still be strong in a Trump administration versus a Biden administration, because it leaves you with that very kind of risk-off sentiment at times, because we know if you increase the price of something, you're going to get less of it. So the threat of tariffs, the imposition on tariffs, generally is something that weakens growth and leads to excess volatility, and markets generally don't like that. But that would be my interpretation. Is China may get a little immediate relief if Biden wins. The currency, the renminbi, should probably do okay because the immediate threat of tariffs go down. I'm not convinced, though, that means China's out of the woods, if you will, when it comes to its relationship with the US. I think it'll be antagonistic no matter who's president.
Excellent. Well, Mike, these were fantastic responses off the cuff. I know you know this stuff inside and out. Thank you for your prepared remarks. If people have questions on some of the detail, we can share that content with you individually and talk through stuff at a personal level. Mike has, as I said earlier, 4 kids, 2 5-year-olds, a 6-year-old, and a 13-year-old. And it's 9 o'clock Eastern time where you are. So we really appreciate you being with us. I'm sure you need to be present at home, but we're very grateful. Our clients are grateful. And I just want to thank you for kind of living out what we talk about in our work, being very intentional with your time and knowledge to share it generously with others. So thank you for that.
You're welcome, Zach. Thank you for the opportunity to be here and talk with you and your clients. I do appreciate it very much. So I'll sign off here and thank you.
Very good. Well, thanks, folks. I'll wrap up with a few comments. One of the things that I loved about tonight is, despite all the data and the uncertainty in the near term, I think we heard a positive message about the long term, and that's something that we all have to wrestle with and say, where is our level of optimism about the future? But we want to help you create a bigger future for your life, and we are better equipped to do that now as part of the Thrivent Advisor Network. You have been gracious, you've been patient, you've walked with us as we've gone through a lot of change. And so I want to close tonight just by talking about a couple logistical things that might be helpful for you. There's some of the questions that we get. And I'm going to do a quick screen share with you to put our website up there. So if you're on the computer at home now or later, you can check this out if you haven't already. But our page, when you load it, the first thing we want you to be aware of and able to do is see what your balances are and to see where your money resides. Some of you have had accounts re-registered at different places. You've had accounts transferred under our new custodian, Fidelity, or you've had your financial planning partnership re-registered under the Thrivent Advisor Network. Our commitment to you is that we're going to deliver exceptional service, and we're going to provide you with more solutions and services than you've had before. And we'll do that with the growing team. But before I get to that team, I want to help you find where your money resides if you haven't yet done that. So at the top of our website are the logins for the 3 most common places that people might find their money. So you can log into Thrivent and see all your Thrivent annuities or insurance products the same way that you always would. We just put a button on our webpage so you can get there quickly through this portal. You can log into Fidelity if you have managed investment accounts. It'll take you right out to the Fidelity webpage. Fidelity has a great app that's very intuitive, so we'd encourage you to use that too to be able to check your balances. And then some of you have accounts that were registered under PKS. It's a brokerage company that can hold accounts from a lot of places, mutual funds, stock portfolios, annuities from different companies. And so you may have an account that's directly held and registered at PKS, or you still may have accounts that are held through different carriers, Principal and Nationwide and Jackson and some of the companies that we utilize. You will still log in directly to those companies to see stuff. So right now, you have access to things by different logins. What's coming down the road, and I want to be cautious as I say this, but part of why we did this is to create a better experience for you. There will be more comprehensive views on statements. There's great interactive software we have in our financial planning partnerships. And so we'll help you utilize those as we get access to it. But the Thrivent Advisor Network is allowing us to connect a lot of different things behind the scenes, and it's just going to take a little while to continue to do that. So who's helping you and who's helping us do that? Well, our advisory team is on here. Corey, my partner, as you know, and Jacob and Jeff and Jay, the 5 of us are the primary advisors. And then we are coordinating and working with all of these great people that you see on the webpage. There's one more in addition to that. We welcomed Ashley Shields. She was a senior vice president at a local bank for the past number of years. She joined our firm at the beginning of August, and we're especially grateful for her and her expertise and experience that helped us launch into this transition that we've been doing the last couple months. And then also, there's some more resources on this page. So there's things we talk about in our meetings. You'll find those on the IntentGen library. There's also a lot of tools out here that look at tax brackets and investment articles and things like that. So we cultivate things that we think are relevant for you, and we'll put them out on the website that you can read through and learn about as you go. All right, so a little bit of a call to action to close. I want you to think back to where you were about 7 months ago in the middle of March with all the uncertainty that was going on. It was without a doubt the busiest work season that I've ever had. We were doing 20, 25 meetings a week. We were talking to more people than that all the time, trying to help people navigate through very uncertain times. And over, we were just reassured by our clients that they were confident in the plans that we had put in place. And I want you to think to the uncertainty of that time, and I hope that our planning work together helped you have more confidence to know that you could continue to live life without stressing about your finances, because we had put things in place to have you ready for that. And there's more uncertainty ahead. Mike talked about that. We know there's always uncertainty in the markets, but we think planning can allow you to live and fulfill the purpose you have and know that your finances are set in place for that. So if there are other people that you think, I want them to have the confidence to be able to think differently and more intentionally about their money, we would welcome the chance to meet them. Our team is better equipped than ever to be able to serve your family and friends, and we'd love to do that. So we greatly value your referrals, your recommendations of us. We know there's some guests that are out there with us tonight, so thanks for being here. We hope it was helpful. As you have heard, there's a lot of uncertain things coming in the markets, in the political environment, and the economy. But at the same time, we also know there's a lot of certain things ahead in terms of your family and the things that you want to do. And our goal is to help you plan for them and be ready for it. So thanks for your trust, your confidence in us and our team. We'll sign off for tonight and look forward to catching up with you soon. Take care, everybody.